in the studio with me. Let me invite Maarten Ackerman, is Chief Economist at Citadel. And via Skype from London, we have Lukman Otunuga. He's a research analyst at FXTM. Gentlemen, thank you for joining me. Maarten, I meant that in haste. I mean, I was guessing. You guys put these things into models and stuff, and then you come up with the sort of numbers where you expect it to come out. And it's always not an exact science. Where were you in terms of that number for the second quarter?
Yeah, so we were somewhere in the middle of the 2%. And you know the reason why...
Like the rest of the market.
Yes,
consensus Bloomberg 2.5, yeah. Reuters consensus 2.5.
So very close to the consensus number. And the reason for that is simply if you look at the high frequency data, so stuff that we're getting throughout the quarter, like retail sales, mining, manufacturing, the PMIs, vehicle sales, you know, that gives you part of the picture, but not the full picture.
Right.
And it's always difficult to think about what the impact will be on things like agriculture and finance. You always got a couple of swing factors or sectors. Yeah. That can influence a number to the up or the downside.
And where was those swing factors for you in this set of numbers today? Well, where was the surprise?
Surprise was definitely mining coming in at
Stronger
double
than
digits.
Yeah.
It was very strong, and also manufacturing, although you know it was only 2.1%, but you know manufacturing is still under a lot of pressure. So printing a positive number was good. And then agriculture, although it's been better than last quarter, which was minus 4% versus minus 13%. Yeah. But yeah, I guess those three were some of the surprising factors.
Yeah. Look, man, from your perspective, I want to know first how far out you were, and then I also want to know, of course, what you saw as a surprise in those numbers.
2.2, 2.3%, roughly around consensus. But the fact that the South African economy has done a complete 180, we're talking about 3.1% contraction in Q1, 3.1% expansion in Q2. It's amazing what a constant power supply can do. And the surprise was actually, as the cancer said, in the mining sector that rebounded 14.4%. So it's quite good for the South African economy. However, though, even though this does put some light at the end of the tunnel, we have to keep in mind that business confidence still remains slightly shaky. So that's something we need to look forward to in the third and fourth quarter of 2019.
Yeah, so I imagine you're not changing any of your forecasts. You know, I'm going to come back to you and ask you where you will be sitting in terms of that rand forecast by come the end of the year. I'll come back to you on that. Maarten, I wanted to know from you. Yeah, so we have had this data coming through and surprising a little bit. But what does that mean in terms of where we go from here from the central bank? Does this increase the likelihood that the governor, who we know is a big hawk, will change his stance in terms of cutting or not cutting?
Yeah, we need to keep in mind that this is only one quarter. So for the year, the number is now 0.9%. Right. And then if we look forward, you know, who knows what the next 2 quarters might do. But even, you know, if we print 2% every quarter, 2019 is still going to struggle to generate more than 1% growth. So we're still in a very weak growth environment, and given the fact that inflation is well maintained at this point in time, and that we're in a global cycle of easier monetary policy and the Fed cutting, you know, I still think there's a lot of room for the Reserve Bank to cut again, or to at least consider that.
You think they should cut, but will they cut?
Well, yeah, it's two very different questions. I do think that you know, the environment is ready for them to put in another cut without making a mistake, because the last print on inflation also went from 4.5% to 4%, so we're now well below the mid-range of the target. And given the still weak environment growth-wise, you know, if they don't do it now, when will they do that?
Absolutely.
So I'm certainly at the, you know, of the view that it is probably the right step for South Africa, and also to alleviate some of the consumers that's under severe pressure. Yeah.
So look, man, we saw the rand run after those numbers came out at the rest of the day, and I think that run is significant today because the rand is running at a time when we know the trade tensions are weighing on the markets and people are fleeing emerging markets. Argentina is coming with capital controls, and so people are not really friendly to emerging markets, and yet we have seen the rand advance. Does that change your outlook to the question that I put to Maarten in terms of the Reserve Bank's ability to cut, and also where does that leave that forecast for you year-end?
Firstly, to answer the first part of your question, yes, the rand is appreciated against almost every single emerging market currency and G10 currency today. But when we look at the rand's performance since the start of August, it's actually not performed that well at all. It's weakened roughly 3% against the dollar. Now, today's GDP report is a welcome development for the South African economy and offers a light at the end of the tunnel. However, I do not think it's going to derail the South African Central Bank from cutting interest rates. As I keep saying, it's a matter of when rather than if, because when we look at the bigger picture, inflation in South Africa remains at 4%. That's quite good. At the same time, we have to keep in mind that South Africa and other emerging market currencies nations remain exposed to external risks in the form of ongoing US-China trade tensions and global growth concerns. So this is a great time for the South African Central Bank to cut interest rates, but two things may prevent them from taking action sooner than expected. The first thing is the fact that the rand has weakened considerably, and this could result in inflationary pressures rebounding sometime in 2019. At the same time, we also have Moody's credit rating decision in November. So these are the two things that could cause the central bank to sit on its hands before taking action sometime in 2020.
Yeah, I don't know if you saw this other headline that came through in the last few minutes. This is the U.S. Treasury yields. This is what the 10-year benchmark falling to the lowest since July. And this after manufacturing data showed U.S. factory sector contracting for the first time since 2016. Many would argue that that means that opens the door, if you like, for the Fed chairman and his compatriots to cut deeper than many were expecting after the last set of comments that we saw coming through from them.
That's true. You know, this disappointing data is going to raise fears over the health of the largest economy in the world. But then when we look at the recent GDP data from the United States, which was squarely at 2%, it becomes the question is the Fed data dependent, trade dependent, or Trump dependent? And right now, when we look at overall data, there's still some argument questioning whether the Fed should be as aggressive in cutting interest rates as markets expect.
Absolutely. Maarten, the question to you then becomes, does this set of numbers, as well as that comment and that data that we saw coming out of the US, create the environment for the South African Reserve Bank to enter a cutting cycle as opposed to the adjustment that we had the Fed talking about?
Yeah, I definitely think, you know, that central banks around the world made a U-turn since December last year.
Yeah.
And, you know, I agree that, you know, a lot of the underlying data in the US is still quite robust, but there are a lot of flags turning red and warning us that, you know, we're heading towards a potential recession, not in the next 12 months, you know, It can be 18 to 24 months. Even Trump is now starting to worrying about it because, you know, that's the last thing he needs heading up to another round of elections. So in that kind of environment, either Fed continues to cut, whether it is as a result of the weaker data or just trying to be preventive, proactive to prevent a recession.
Yeah.
You know, that's an international factor that's actually also creating an environment for the South African Reserve Bank to actually cut. So it will be very odd in this environment where most people are, or most central banks are actually cutting rates, for our central bank to say, well, you know, they're going to not act at all.
Yeah.
The risk of weaker currency and the impact on inflation 12, 18 months down the line, it is there to an extent, but we also have seen of late that the pass-through from a weaker currency is less and less.
Has been contained, yes.
On the South African economy.
Yeah.
So I do think, you know, we probably at a point where if they really consider everything, they could really consider a cut.
Yeah. So two-pronged question. After these numbers then, do you revise your GDP number for 2019, and where does that lie? And then sustainability also of the momentum that we're seeing in that second quarter.
Yeah, I think, you know, this is a much better number than expected. It shows us at least that we can still get 3% out of this economy. So the economy is not dead. You know, if everything falls into place, so we don't have load shedding, we don't have disruptive strikes, we've got a stable global economy, we can get 3%. This is what this number is showing us. Okay. If you get the volatility of the structural issues that we're dealing on a daily basis, then, and we're not going to solve that overnight, then we're still in for a more volatile period in terms of growth. Okay. But it just shows once again that the minute we can actually fast-track reform, these kind of numbers are possible. Right. So bringing us back to the rest of this year, Our number is still probably sitting around about 0.8 for the whole of 2019.
Sure.
Because even if you print another 2 for both the third and the fourth quarter, that brings you to about just below 1%. So my expectation is that if you look at the Reserve Bank and the Treasury at this point in time, they're probably slightly below that. And it may be prudent given that we've budgeted 1.5 in February. Next month, we've got the medium-term budget, and we know it's going to be a tough budget. So, you know, in reality, whether it's 0.8 or 1%, it's still not enough. We need to get at an annual rate of 3%, which we'll only get to if we can stay on track and get more of these kind of quarters.
Absolutely, no question about that. Thanks very much, Maarten, for coming in today. Thank you as well to Lukman, who joined us via Skype from London for chatting about the numbers that we saw today.